joining and participating. I want to start with some quick introductions, and then we will get into our discussion. We are here to talk about joining and participating. We are here to talk about a piece published on Phenomenal World, a publication of Jain Institute, written by Karthik Sankaran. Karthik is a senior research fellow in geoeconomics in the Global South program at the Quincy Institute for Responsible Statecraft. He was originally trained as a modern European historian, but instead pursued careers in journalism and then finance as a strategist and as a trade and portfolio manager. We also have Brad Setzer, the Whitney Shepherdson Senior Fellow at CFR. His expertise includes global trade, capital flows, financial vulnerability analysis, and sovereign debt restructuring. His blog is Follow the Money. We also have Mona Ali, Associate Professor of Economics at SUNY. Her research on international political economy been published in Cambridge Journal of Economics, International View of Applied Economics, Géopolitique, Réseau, Energy, Environment, Nature, among elsewhere. And then I am Michael. I'm CEO of Jain Institute and our lucky moderator. Logistics. This is going to be a 90-minute event. For roughly the first hour, I will moderate, and then for the last, say, 20 to 30 minutes, we will have questions from you all, or more questions from me if you have none. There should be a Q&A function in the chat, which I will run. Right. Great. Okay. So we're here to talk about Karthik's piece as an occasion for understanding how the Trump administration is trying to change the dollar and global trade and finance. And fortuitously, we're having this discussion exactly one day before we are reliberated by new tariff announcements. So this is great timing. I want to start with a joke. I'm going to self-plagiarize myself. I've said this joke in public before, but not to this group, that I like that frames us up nicely. So there's an old joke in Latin American politics that goes, why has there never been a revolution in the United States? And the reason is there's no American embassy in Washington. Where we are now, in a sense, I think we do have an American embassy in Washington. And the dollar is in its sights. So to quote Karthik's piece, on the specific question of the dollar itself, Trump administration policy can be characterized as confused. It wants a weak dollar to spur reindustrialization in the US, and a strong dollar to offset any inflationary pass-through from tariffs. It certainly does not want a combination of dollar weakness and higher bond yields, which is generally interpreted as a crisis of confidence in the currency. In addition, this administration is increasingly concerned that high bond coupons will increase the deficit of debt, and seem to think that large foreign inflows into US bonds could help hold down interest rates. Finally, it is absolutely determined to retain the centrality of the dollar in the international monetary system, even though several key administration officials believe, mistakenly, that dollar centrality leads to undesirable dollar strength. So to start us off, I'm going to ask each of our panelists just to give us a 3 to 5 minute picture of where we are in these questions, especially where administration policy is now. This piece was published about, I think, 6 weeks ago, and a lot is incredibly changed. So I think I'll start with Mona and then Brad, and then close with Karthik on their pictures, and then we'll get into the questions.
All right. Thank you, Michael. It's delightful to be here. So yeah, I want to address the first sort of question you'd asked us, which is the question of the US trade deficit. Indeed, the US trade deficit, which is about 1.2 trillion last year, the financial account surplus, which is about 2 trillion. It's all those inflows coming into the US with the higher interest rates and the strong dollar last year. They're definitely symptomatic or a byproduct of the United States dollar centrality in trade and financial networks, right? So Trump also sort of this whole idea about rebalancing is actually goes back to Biden administration people, and it's been taken on in a big way from a guy who loves tariffs. It's a word that's very dear to him. And so his goal, Trump's goal, is to shrink the US merchandise trade deficit. And he's going to do that through tariffs, purportedly. And the other part of the negotiation that he's conducting with trade partners is for them to set up platforms, inward foreign direct investment in the United States. Now, there is a precursor in the 1932 UK tariffs on the rest of the world. And this is before the Sterling area policies, where the hegemon, the imperial hegemon, was negotiating with its partner, well, not really partners, but those in the imperial sphere, privileged access to the UK market in exchange for a reduction in their own tariffs, right? So Australia and Canada, et cetera, would be negotiating with the UK. So there is that kind of history, and there's also continuity between what Trump is doing and folks in the Biden administration, for whom, the question, and Brad can speak to this, the question of the China's current account deficit became a central preoccupation. Now, I want to just step back for a second and just remind everyone that for the last 25 years, the United States has been the biggest driver of global imbalances, right? No doubt, China has ramped up its exports, especially in the last few years. But the central story over the last quarter of century has been one where global imbalances are driven by the United States. So global imbalances are a problem in my view, but I think they're a symptom of the deeper asymmetry in the global financial architecture. And I think addressing the problem, the symptom, is not going to address the underlying problem. So I guess you guys could talk more about the trade war, right? Yesterday, we had the announcement of 25% tariffs on imports from India, announced by Trump, and of course, 50% on Brazil. And we can also talk about Liberation Day and the impact that had on the dollar, 10% depreciation, which is a good thing for global growth, right? So it's been the one silver lining, the recent dollar depreciation, although recently the dollar is back up again. So what happens to the dollar? Of course, it's determined in exchange markets, right, that move digital second by digital second. It's ultimately going to be decided by financial markets and how they digest the forthcoming shocks of the Trump administration. We know that market volatility will hurt businesses. We know it hurts households, but it's been incredibly beneficial for Wall Street, especially for the big banks, right? JP Morgan Chase, Goldman Sachs recording their decade best profits. So the question is, will it work? And here we can think about Charles Goodhart. And according to that kind of idea that a policy target is bound to be subverted by economic agents, we can see that already in the first quarter with the front running of tariffs, gold imports. We saw a 44.3% increase in the US trade deficit. One way to reduce deficits is by crashing the US macroeconomy, and that seems to be the trend where Trump's inchoate policies are headed towards, right? So here we have a president who's, it's an imperial presidency, extracting tribute in the form of tariffs, not going to reduce the budget deficit, which is going to rise about 3.4 trillion in the next decade. Now, all this inward FDI or portfolio investment in treasuries will only increase the stock of US foreign liabilities. I want to remind folks that the net international investment position is about 84% of US GDP. That's about negative, $25 trillion, right? So, and what is the Trump administration doing? Well, Treasury is just wrapping up the issuance of short-term treasuries, which with the new relaxation of capital requirements on banks is going to create sort of a setting up the stage for another crisis, shall we say. So I'll leave it at that.
Thanks, Mona. Brad, what's your view on this?
Well, a couple of thoughts. One is that I would actually push back pretty strongly against Mona's characterization that the U.S. deficit over the full 25 years of recent history has been driven by the United States. I don't think that's a reasonable read of what happened in the U.S. economy between 2002 and 2013 and 2014. I think that is a period when emerging markets and emerging market reserve accumulation actually did push other parts of the world economy into bigger deficits than otherwise would have been the case. That is actually the period when the U.S. fiscal deficit, if you go back and look at it, between 2005, 2006, 2007 was 2 to 3% of US GDP. It's also a period where, except for the peak of the housing bubble, I would argue the US had a demand problem. The US was generally operating below capacity, and the US wasn't clearly pulling in private capital because its economy was growing fast, and that was offering returns that you couldn't get elsewhere. That was the period of unprecedented global reserve accumulation. And I would just note that it is extremely unusual for a country like China, which is now the biggest oil importer, was still a sizable oil importer, an enormous resource exporter, to simultaneously run a large current account surplus when the oil exporters and the resource exporters are also running current account surpluses. I do think this changed in the past 10 years, and we shifted to a regime where, with fiscal loosening in the US, faster growth in the US, the outperformance of US stock markets, much higher interest rates in the US than in the other advanced economies, where you can make a very plausible case that much of the external imbalance now does stem from the US and from US policy. But I don't view it as a continuity. I believe there's a very important structural break around 2014 when the dollar appreciated and the US external deficit shifted from largely being financed by official flows to largely being financed by return-seeking private flows. Right now, we're in a slightly different era where the US external deficit isn't the main vector of global adjustment in some surprising ways. China's surplus on the good side has soared. There's a measurement issue, and much of the counterpart is in the US. But I also think if you take away some of the pharmaceutical tax games, an awful lot of the adjustment is now coming from a lower surplus in Europe. So I don't think you can understand the rise in China's surplus right now simply as a mere image of the US deficit. I also have a slightly different take on what the Trump administration is doing. I think the surprise, in some sense, is that the dollar has played such a small role in these trade deals and such a small role in the actual policy discussion. Stephen Moran, the head of the CEA, did have a paper that everyone read that suggested there was this complex thesis around the dollar and the dollar's role. The actual trade deals we're seeing haven't been based around using the dollar as leverage, nor have they tried to address in any obvious way what I would view as this ongoing dollar overvaluation. And, the little blip down in the dollar has only reversed the appreciation after Trump's election. The dollar at an objective level is still incredibly strong, 30% stronger than it was in 2014. That just hasn't been part of any of these deals. Instead, I think the Trump administration has weaponized or used as leverage, not the dollar, but this fact that the US still supplies the world with excess demand. It's weaponized, in a sense, our trade deficit, and more or less has said continued access to our demand in a world that is now short demand, unlike 2 or 3 years ago, where Europe really isn't growing, where China isn't growing, where China's in deflation. The US has basically said, we're going to condition access to our market on your willingness to, A, not retaliate for significant increases in our tariffs. 10 for the UK, 15 for Europe, around 20 for Southeast Asia, now 25 for India, although that's a negotiation, 30 for China. You can't retaliate, part A. And then part B, we actually want you to lower your tariffs on our goods too. No discussion of the dollar in any of that. And then these investment deals, which if they were real, and they don't seem to be, would imply additional inflows into the dollar and into the US that would work against the desired goal of reducing the trade deficit. I think we all agree there's a certain incoherence there. The only way that it is maybe not incoherent is that there's no evidence that the actual numbers in these investment deals are real. And there's a certain chance that, to the extent that they are real, they will come out of other portfolio flows and therefore not be a net expansion in the inflow into the US that widens the deficit. The only way this administration is going to bring the trade deficit down with their current policy mix is if the tariffs are a big enough tax on the imported component of consumption that they reduce our spending power And by reducing our spending power, we get a fiscal consolidation despite the tax cuts, which is possible given how high the tariffs have gone. And that slows the economy and brings the trade deficit down. Otherwise, to me, the story of this administration's trade policy is how little the dollar has actually played in.
Thank you very much. Before Karthik goes, Mona, do you want to reply to any of that quickly?
So I like your kind of periodization of imbalances. I think that's useful. I just want to make the point that with regard to Trump, I mean, in terms of rebalancing, we've seen an increase in the dollar, right? Of the trade deficit, sorry, with both dollar depreciation in 2003 to 2008, as well as dollar appreciation from 2019 to 2014, both associated, appreciation and depreciation, with a rising trade deficit. Now, I do appreciate your regional kind of decomposition, but I think very much that the United States market is central to driving imports are central to driving global imbalances. In terms of, I never made the argument that the dollar's been central to recent trade deals. I'll say more. I think we should hear from Karthik, because this is some of what is there in Karthik's piece as well about.
Yeah, we'll get right into this, Brad. So yeah, Karthik, maybe you can frame us up and then we'll
can I just quickly respond to that?
Sure.
Because just as a factual matter, trade deficits respond to the dollar with a lag. And you have to adjust for oil and non-oil balances. So you actually did see a fall in the non-oil trade balance after the dollar depreciated with a 2-year lag. So you will very clearly see a fall in the non-oil trade deficit from 2005 to 2012. Once the dollar started to reappreciate, you will see the non-oil deficit go up. But that is the period, and this is something Karthik has written about extensively, where there's an enormous adjustment in the oil balance with Saudi America. But there simply is in the data a very clear correlation between the non-oil trade deficit and the dollar over this full 25-year period.
Yeah, I mean, I think I'm going to try to, because Brad and I we've talked about this separate, online separately, and we have points of agreement, points of disagreement. I don't want this to turn into my argument with Michael Pettis about causal mechanisms, so which is not, which is an entirely different beef that I have about whether one can infer causation from accounting identities. But anyway, separately from that, I mean, I do agree that the dollar valuation itself has not played a particularly large role, notwithstanding what Steve Moran said about it twice. First in the extremely long, 40-page piece, and then the mercifully shorter 5-page address he gave at the Hudson Institute once he was in office. So I'm going to focus a little more on dollar role here than dollar valuation, because while I do disagree with some people that dollar valuation or dollar overvaluation is persistently explained over the entire 50 years of the post Bretton Woods one era by dollar centrality, because it's gone up and down. What strikes me more now is partly this idea of weaponizing market access, in a sense that, or basically using market access as a way for the U.S. to get certain goals. A persistent insistence on dollar centrality as being vitally important, which I think is, and that's been a strong element of bipartisan continuity on that front, and it was partly, it's partly about sanctions. And one of the things we have seen over the last 10 years is a dramatic increase in the the scope of sanctions, from being targeted primarily at pariah states to now they're being used as part of a much more aggressive export control agenda, which is part of great power competition, the technological aspects of great power competition. Henry Farrell's written a lot about this. So, so the insistence on centrality is something that I think is interesting. The third is the idea of what Miranda said, and I think the administration believes, is that the US provides certain global public goods. It provides final demand and it provides defense. And these come at a cost to the United States. I would disagree to some extent with the cost, because I'm not a big believer in the exorbitant burden argument. Certainly compared with other countries, I would argue that the US remains the most sovereign in the system because it has large external deficits, but does not face the prospect of balance payments crises, while simultaneously, as the issuer of the central currency in the system, it also gets to exercise some of the privileges of a hegemonic creditor in the sense of imposing conditionality for concessional access, for concessional lending. So it gets to be both the United States and also to act as Germany did during the Eurozone crisis, for instance, in terms of conditionality, not in terms of, so I think all of that's part of what Mona has written about, and so even while dollar valuation itself is not necessarily a central part of what the administration wants, I think market access, dollar centrality, and the desire for persistent for external financing to come into the U.S. to hold down interest rates in the face of expanding fiscal deficits is something that does seem to matter, that they talk about a lot. Sometimes it takes the form of purported deals with large inflows of money that are double, triple, quadruple counting of the actual flows. There's also the stablecoin initiative. So it does seem as though, right at this point, I'd say low interest rates, dollar centrality, and lower trade deficits remain part of the fundamental, check boxes the administration wants to check. Dollar valuation is not necessarily such a large goal, in part because the scale of tariffs potentially reduces the impact of dollar valuation, because essentially they're saying, well, even if your stuff is cheap, you can't come in here. You have to hit this tariff. So I'd agree on the kind of on the, but I think so. I'd say one area where things are different is the dollar valuation per se is no longer a key part of this. That said, I do think the combination of a weak, what we saw between April 9th and until about a week ago, the combination of a weak dollar and higher bond yields was seen as problematic. And what's interesting here, in terms of what seems to have turned the dollar around to some degree, it may have been flagging, people may have been, over long. But I think part of the story there is what happened with the EU deal. And there's kind of a traditional explanation, which is that traditional market explanation, that what happened was that the market was reacting to the fact that a deal like that would be inflationary for the US, disinflationary for the Eurozone. So the ECB would probably cut rates. The Fed would be later to cut. So that was one explanation for that move down from high 116s to 114.5 or something, where we are right now. I haven't checked. But I think there may be another aspect here, which is part of my story that I tried to tell, was that precisely the conditionality attached to the provision of global public goods was leading to a reaction outside the US that may fiscal expansion in the European case, defense centric, and talk of, oh, we're going to make the euro a more suitable competitor to the dollar, and so on and so forth. There was a lot of stuff about that in the press and in official speeches. And my interpretation is that at least part of what happened in the market was people wondering, well, are the Europeans serious? Do we really take the Europeans as seriously as we did in the 2 to 3 weeks after Vance's speech in Munich, and then Merz responding, and so on? And my view on that is, we'll wait and see. I don't think they're backing away from that completely, but this is kind of where I see the piece that kind of initially, started writing it, about 3 months ago, and it's gone through a few different iterations. But since it landed, I think on July 7th or something like that, the most interesting piece to me is whether or not how one should think about the rest of the world response to this U.S. attempt to monetize, to essentially gain more financially from provision of global public goods, and whether that initial reaction that was priced in the market that I thought would drive things, has it receded completely, or is it just abating to some limited extent? I'll stop here.
No, that's a great segue, and thank you all for for framing up where we are. I think before we get to the rest of the global reaction, which I agree has been fascinating to watch, and since the piece has been published, I think that the two big developments to my eye, I'll open the correction here, is that the profit-seeking private flows into U.S. equities have continued roughly unabated, and also the EU response and Germany maybe starting to come to terms with a two-front trade war with the US and China, and how that positions the EU. Both really, really fascinating. Before we get to that, I want to pick up on something that Brad said about what the objectives are of the current policy mix. Because, right, so the dollar's role, and especially US excess demand, is being leveraged. And it seems to be being leveraged for unresponsiveness to our tariffs and for foreign direct investment into the US, maybe as a substitute for, say, tax-financed industrial policy, with a big question mark on how real this is and what it'll actually go to. What is the point of that? Is it simply a projection of power? Is it a substitute for US financed industrial policy? Is it an attempt to rebalance our internal labor market and political economy towards some revived manufacturing? I have had different thoughts at different points, but I think just to orient us on where the American embassy is pushing the US government right now, I want to get a sense of where everyone sees that policy objective. Maybe I can, Brad, since you introduced it, I could ask you for it.
So I think the Trump policy mix should just be understood as a Trump policy mix. It shouldn't be understood as a coherent policy mix. It should be understood as the reflection of the goals and desires of our chief trade negotiator, who also happens to be the president of the United States. And because he is the president, because he is a skilled communicator, a former reality TV star, an enormous part of these deals seems to be driven by what he believes personally, and also what he believes he can sell. I'm not convinced there's a coherent economic theory of the case. If you had a coherent economic theory about how you wanted to revive US manufacturing, You would not fight a trade war with Brazil. I mean, Brazil is a net importer of US manufacturers. You would not fight a trade war with Canada. Canada is also a net importer of US manufacturers. You wouldn't look to tariffs as the solution to the very only solution to the very real problems created by China's overinvestment and overcapacity in the production of industrial metals. Because a 50% steel tariff, which does generate rents and pulls up the domestic price of steel, as we've seen, and we have much higher steel prices across the board than our trade competitors, it penalizes exports. And by most accounts, it generates a modest increase in steel output, although so far we haven't seen it, even with protection pretty consistently over the past 8 years, which is sort of disappointing. But it actually reduces manufacturing output because of the downstream. So I don't think there's coherence yet. There is a dislike of bilateral deficits, and there is a deep love, one might say, for deals which the president can say, this is a big pool of money that's going to come into the US and it's going to be guided by Donald J. Trump. Nothing more. Now, within that, you can argue that the combination of tariffs plus directed foreign direct investment, to the extent that actually happens, is this administration's substitute for much of the Biden administration's attempt at industrial policy, with a significant shift away from clean energy, clean technologies towards different sectors. So we're probably more emphasis on ships, but hey, ships were up and coming at the end of the Biden administration too. We'll see where the chips tariffs line up. But in a sense, the Trump administration thinks you can do with tariffs what was done with tax incentives under Biden. And presumably, the foreign direct investment that is being invited in or coerced in is the alternative to the foreign direct investment in semiconductor production that the Biden administration tried to induce in with favorable investment incentives. So there may be a second best attempt to allow other people to pay for our industrial policy. That's kind of how the Trump administration pays for it. My gut is that when you rely on other people, you don't get the best outcomes, but I guess that's to be determined. Overarching point, though, is I don't see coherence, nor do I assume coherence.
Just to pick up one thread quickly, you said in your opening comments that you think there is a chance that this does reduce overall trade deficit. Do you see part of the point of that as effectively financing tax cuts? I'm trying to find some rationale here, because when you step back from a lot of the administration's rhetoric and look at what they've invested political capital in, it's tariffs and it's tax cuts, and I'm trying to find sort of a connection there.
Yeah, sure. I mean, the tariff revenue on track to generate at least, there was 25 basis points, a quarter point of GDP in baseline tariff revenue. We're already seeing another 3/4 of a point of GDP in additional tariff revenue.
Yep.
And I think the additional tariff revenue will be at least 1%. And maybe, as we keep ratcheting tariffs up, I would put that at a higher number. So yes, it is. I wouldn't say it's financing the tax cuts, but it is offsetting the immediate impact of the tax cuts. And by that, I mean, it is also offsetting the stimulative impact of the tax cuts. Yep. You're taking money out, even as the tax cuts are putting money in to consumer purchase power. Now, there's a part of the tax cuts which is returning to full expensing, which should be understood a little differently, but no tax on tips, no tax on overtime, not quite no tax on Social Security is giving money to enhancing people's spending power, and the tariffs are taking away. Why I think there may be some reduction in the trade deficit is simply that the administration likes tariffs so much that they're pushing the tariff collection take above the near-term tax giveaway. So if you do a quarter point or a half point or a 3/4 point tax increase, the administration would say, well, it's being paid for by the rest of the world. And, to some degree, a tiny bit, maybe, because other producers like Toyota may absorb some of it, but most of it is clearly being absorbed by the U.S. economy, either by businesses or consumers. So it's functionally a tax hike on different parts of the U.S. economy. And if that tax hike is big enough, I think any standard macroeconomic model would have a reduction in the trade deficit. You slow the economy, and even Jay Powell, if the economy slows enough, and if it is clear that the tariffs are just a one-off adjustment in the price level, they're not engendering sustained inflationary pressure. If the economy slows and it's currently growing at 1.5%, kind of ballparky, slows to 1, that would, and the Fed starts a cutting cycle, classic conditions for some adjustment.
Thanks, Mona. I saw you on mute if you want to come.
So I want to go back to this idea of the dollar, and I totally am with Brad on this, that the story right now about the trade wars is not about weaponizing the dollar, right? And when we talk about weaponizing the dollar, Karthik talked about sanctions, etc. I mean, that is, that may happen with the Mar-a-Lago Accord, right? That is yet to be realized. But I want to just pick up on something that Karthik and I think Brad also mentioned, which is this, well, Brad, I don't think you mentioned it, but this idea of the dollar as the global public good. And, I want to sort of question that logic. I mean, the dollar is a beast, it's a behemoth, right? And large parts of it are not even within the control of the Fed or the Treasury. And who benefits from the dollar? It's private finance, right? And so do we really want to continue with this Kindlebergian notion that the dollar is a public good? And I understand that, China, Asia, Europe has willingly, of its own accord, invested in dollar securities and treasuries, bonds, etc. I mean, Europe's one of the biggest players here by region. So what does it mean for us if we understand that the dollar is not a public good, but in fact that issuing the world's hegemonic currency and having a role to play as a backstop, right? It's an imperial backstop, the Fed's swap line structure. I mean, I wonder what Mar-a-Lago, for instance, would look like in that context, right? I can say much more, but in my view, the dollar is not an international public good. Instead, it's a private market-led system with an imperial backstop. So, and I know we're moving away from, the trade discussion right now.
Yeah, no, if I may, I as a member of Team Multipolar, I mean, I would broadly agree with you in the sense that it is presented as a global public good, and that's Moran's argument. And I had this recent back and forth. Martin Wolf said something about how a multipolar global financial order would lead to greater instability than a unipolar financial order. Someone who's been involved kind of in emerging markets for a very long time, I think, and we both. I think everyone has seen this from everyone here has seen this from different sides. I tend to look at it in terms of a global financial cycle that starts in that is kind of led by the United States, which may have made some sense when the United States was a much larger portion of the global economy, but as it shrank in terms of its significance, and here you basically have a problem of asynchronous real and financial cycles, which is especially problematic for commodity exporters because they borrow in dollars. The left-hand side of the dollar smile is famous for when the world economy falls off a cliff, the dollar is supposed to rally, commodity prices fall. This is kind of a rinse and repeat story in emerging markets that we've seen over and over again. So I think there's that issue with having that's one of the issues with having presenting the dollar as a global public good, when the other is something, and I think I referred to this when I said the US in a sense has the best of both worlds, because dollar centrality means it's fundamentally immune from balance of payments constraints, while at the same time it gets to impose conditionality as the lender of last resort. Because so, the way I phrase this, the U.S. has the prerogatives simultaneously being hegemonic debtor in the system and also a hegemonic creditor in the system. It gets both. It gets both things. And there's more symmetry in a sense with large developed market economies with surpluses or perhaps even China, because, and this is something Brad and I agree on, this discourse about cutting off swap lines, that's clearly an issue where it would backfire tremendously, because when you have a net international investment position of negative 85% of GDP or 90% of GDP, clearly the world is long dollars, but running maturity mismatches, liquidity mismatches, all kinds of other things, all kinds of other mismatches, and that's why the swap lines exist. So, but not everybody gets a swap line, right? The global south does not get swap lines. It's basically large external creditors who get those for reasons of preserving financial stability. Now, I think we all worry separately that this fact is not sufficiently understood, and so you will get periodic outbreaks of cut off the swap lines. That'll teach the Europeans, cut off the swap. So that's a whole that's a whole other discourse. But I guess my final point here is, and this is probably closer to you, Mona, than to you, Brad, is that I think at least part of what we've seen in the world is a response to this, particularly in the aftermath of the Asian financial crisis. Maybe it's exaggerated, but fundamentally the fact remains that large surplus emerging markets have learned that you need to go to extraordinary lengths to protect yourself from balance of payments crises, because the welfare costs are enormous, and that assistance is not always forthcoming without giving up a degree of sovereignty. So I would characterize at least part of what's happening as an adaptive response to dollar centrality. And as long as you have a situation where the international monetary system is configured like this, you will end up with situations in which precautionary reserve accumulation becomes an alibi for mercantilist reserve accumulation. So, and this is all kind of built in the structure. And again, to return to kind of like Banco, he's not here, Michael Pettis, talking about, if we only had Bancor, is about as useful as me saying, if only they hadn't shot the Archduke. I mean, it really doesn't, that's not the world we live in, right? So, so this, so I think of at least part of the story is an adaptive response in large surplus emerging markets, or even deficit emerging markets like India that had at least in one semester ended up on the wrong end of the Treasury currency manipulation report. It's an adaptive response to the system where the dollar does act as a wrecking ball, which is another aspect of centrality that does seem attractive, precisely because concessional lending comes with the ability to impose conditionality.
Yeah, that's a great. So I want to get to the sort of adaptive responses, to use your phrase, from around the world, and because I think that obviously what's happened since your piece is we have sort of the first indication of where and how the rest of the world is going to respond. Like I said, the big developments to my eye are that investment into U.S. assets has not slowed down much at all. And to Brad's point about the periodization of demand for the dollar, we are in the period where demand for the dollar, that's its main vector, as I understand it. And at the same time, we did have these initial indications, China trying to manage its demand, Germany trying to manage its demand. I think the jury's out on how successful that's going to be in both cases. But I want to talk about what the global response in your eyes has been so far, but also what further impulses out of Washington are going to induce what further responses. Because I think, Mona alluded to the Mar-a-Lago Accords. I don't think one thing I feel confident in predicting is that the administration is not going to slow down this, or at least it's very unlikely to. And I think we're going to see continued new policy here, especially to Brad's point. This is a favored tool communication style of our chief negotiator. So I mean, maybe Mona, we can start with you on where you see the world responding, and what further impulses out of the U.S. are going to induce what further responses.
Well, we saw the European capitulation, and who knows whether the Europeans will indeed purchase $750 billion in U.S. fossil fuel imports. But it's there in the White House document 2028. And the question is, will Trump again weaponize access to swap lines if the Europeans don't make good on their promises to import U.S. weapons as well as U.S. energy? So that's Europe's response. And again, Europe is very much peripheral in the global dollar system, right? I mean, it's unfortunately shown that, even though I agree with Brad, and Brad has a nice piece on this, about how Europe has financial power, how it has military power, and how it's really wasted its historic opportunity right now to think about regional, its regional military industrial complex or regional green financing. And it's really sort of thwarted a very opportune moment to think about common European, financing and investment mechanisms. So if that's Europe's response, right? China, I mean, has been different. It's pushed back. We saw earlier this year. And by the way, Europe should take maybe a page from the Chinese trade book back in, I believe, 2020, in the first trade agreement that that U.S. and China did, where the U.S. again, Trump was coercing China to purchase imports from the United States, and China only purchased about 58%. That was the agreement back in 2020. So the Europeans could take a page from that Chinese playbook and simply not deliver. China's played hardball, right? It stopped its LNG imports. It threatened to stop sending its semiconductor chips. So China's playing hardball in a way that Europe isn't. Now, I want to just come to this question that, well, I think we might talk about that later, but the question of the exchange rate manipulation, no doubt China does that. All right, not going to dispute that. However, another question we want to pose is, why not the United States manage its exchange rate better, right? Exchange rate management of the dollar, given the systemic nature of the dollar in the world financial system. And that's another line of conversation that we can think about. So I'm all for the exchange rate management of the dollar, industrial policy in the United States and in Europe, and maybe subsidize to the max, but not I think tariffs, the way it's going to be used, it's by the most powerful player in the system, to the detriment of others. So those are some kind of broad ideas. I'll stop there.
Thanks, Mona. Brad, I want to bring you in here, especially on sort of the private market response for return-seeking private flows, but also, been tracking online the sort of German, China, U.S. dance and how they're sort of mutually responding.
Well, I'll agree a little bit with Mona. I also think the U.S. should have a capacity to do a bit of counter-intervention. And frankly, I don't have Karthik's complete confidence that the U.S. is completely immune to a balance of payments crisis. We don't have the balance sheet risk from borrowing in someone else's currency. But a sudden adjustment in the dollar would be very painful because it would push up import prices, and our export sector is small and it wouldn't respond quickly. So we would feel the pain from a big move in the dollar. And we are refinancing an incredible amount of external debt in our own currency, it is true, while having a reserve portfolio that is essentially zero if you exclude gold. So a lot of people.
Question. If I could, I think to draw that out a bit. So our version of the mountain payments crisis looks something like our imports get suddenly very expensive and nuked. The consumer demand is nuked, and our export sector, because it's smaller and, as you pointed out, in steel, it doesn't seem especially agile or policy responsive, at least not yet. We don't make up for that in the labor market, and we don't make up for that in productivity. Is that's sort of your picture of how that would go?
Yes, initially it's a painful adjustment. Higher import prices. A certain part of our imports we have to buy. You're going to need new clothes every so often. And if you spend more on clothes, you'll spend less going out to eat and so forth and so on. And so that will lead to a reduction in demand, a reduction in domestic output in the non-tradable sector because of the negative price shock. And then the offset, which will come, but it'll come slowly. It comes slowly because we're starting off with an incredibly small export sector, like 4 or 5% of GDP in non-petrol goods, depending on how you net out re-exports, a couple of points in services exports, some of which are not very responsive to the currency because they're basically IP-related transfer prices, some of which are very responsive to the currency because of their tourism. But you'd have to actually have a more pleasant experience with U.S. immigration to probably capitalize on
really
that. So, it's just the math works out so that, like, if there's a really, really big move in the dollar, the first order effects are going to be pretty negative. Point being, I wouldn't be opposed if the U.S. gave up not gave up, but reduced what some people argue is the biggest benefit of being the reserve currency, which is you don't have to hold any reserves of your own. We haven't had to hold yen. We haven't had to hold euro. So we haven't had to have the negative interest rate, the negative carry from borrowing dollars and then buying euro. On the other hand, that does create a little bit of an asymmetry because other countries hold dollars and we don't hold their currencies. And so that naturally, it creates a built-in base of demand for our treasuries, which we like. But it means that there's a little bit of an asymmetry there and an asymmetry in flows. I don't think all that matters very much for how China is responding, how Germany is responding, France, UK too. Look, the natural response to the biggest deficit country, weaponizing market access or weaponizing access to its demand, forcing countries to accept unequal deals, would be to rely more on yourselves. And I think the irony is that China has so far been utterly incapable of making that shift. Now, there are signs that China is recognizing because domestic output is so high that even with record exports, even with close to 2 percentage points of growth from net exports, basically half of China's growth from net exports, a huge number, even with that, domestic price competition is so severe that China's caught in deflation. Factories have to close down or operate at losses just because there's so, if you're producing 2 times world demand, you can expand world demand a bit, but you basically are going to be in a position where you're driving each other. Your one province's photovoltaic factory is going to drive another province's photovoltaic factory out. So China recognizing there's a bit of a problem, but they haven't, in my mind, made the kind of decisive policy steps that would suggest they recognize they can't rely on global demand. Instead, I think they are trying to do what they did very successfully in the first Trump trade war, which is to keep access to the U.S. market indirectly by exporting parts for final assembly elsewhere, and by keeping Europe's market open, because they can sell to Europe, and then as long as Europe can offset imports from China with exports to the U.S., the net impact on the European economy is minimized. The same basic logic applies in Europe. The solution to a trade partner like the United States weaponizing access to its demand is to rely more on your own demand. A global euro could be part of that, in the sense that right now, if there was a more coherent European debt market, or even if there was just more boon supply, which we're probably going to get, you should have a higher fraction of global safe assets being held in euros, partially because the dollar is not that safe anymore. When you have this level of debt with this kind of fiscal trajectory, you may be historically a safe asset, but you're not obviously a safe asset going forward. So there should be more demand for euros. There should be more capacity to run up fiscal deficits. And in Germany and Northern Europe's case, to do so to address your security dependence, which is the direction in which Germany is going. Now, there are still constraints. And those constraints, I think, are part of the reason why Europe is still a little reluctant to have too strong a euro, too many inflows into the euro area. One is that Germany liberalized the debt brake just for some things. So there's still a need for some fiscal consolidation elsewhere, because there's a lot of subsidies to offset the high energy costs and so forth and so on. So overall German fiscal policy may not be quite as expansionary as you would infer from the expansion in Germany's military spending, which is very real. It is going to happen, in my view. But then the other is, while Northern Europe, within Europe's rules, is both sort of on the front line vis-a-vis Russia, some Southeastern Europe, but a lot, the Nordics, Germany, Poland, are on the front lines, feel most threatened, and have the most fiscal capacity within Europe's rules and generally. The Swedes can borrow as much as they want. The Danes can borrow as much as they want. Norway doesn't even need to borrow. It could just put less money into its sovereign wealth fund. Germany can borrow as much as it wants without that much upward pressure on rates. Maybe it actually would end up putting upward pressure on US rates because there'd be less money flowing out. But France, Italy are perceived to be in a position where they need to do fiscal consolidation. And I think probably that perception is true in France. And perceived to be in a position where they need to bring down their debt levels. So they have less scope to use a fiscal offset to generate demand. And that means that the overall response of the euro area has to reflect the balance between those who didn't use their fiscal capacity over the past 20 years and now have lots of it, and those who used it or got stuck in a negative debt spiral. I mean, if you look at Italy, their really bad fiscal policy was arguably before they joined the euro. And has since then just been a kind of high interest rate trap. France, they used it during the global financial crisis. They've used it after. Now they probably can't use it that much more. So, both China, I would say, and Europe have been a little bit constrained in their willingness to go all in around a model where they reduce their dependence on the US by spending more at home. China, because its complex internal political dynamics, Xi is still pretty reluctant to give money to households. Local governments are clearly reluctant to drop a model which has worked for them, where they support local factories that hope to become world-beating in new technologies. And Europe, it's just such a mix. But I think on balance, Europe is moving slowly in the right direction and moving towards a world where it'll be with a lag, less dependent on the US for security. The European banks are already a lot less dependent on the swap lines than they were in 07, 08 because of a lot of the banking regulations were designed to reduce that dependence. The true dependence on swap lines, frankly, is in Japan. And Taiwan too, but Taiwan has so many reserves, it's an irrelevant point. And moving towards a world where they aren't as dependent on an access to the US market. Now, that said, in order for Europe to be less reliant on the US market, Europe cannot give its own market to China, which is the argument I've been making. And that's a hard conclusion for many in Europe to draw and to accept. I think they're coming there, but Europe has part of its general response to Trump tearing up the rules, to weaponizing market access, to doing things you're not supposed to do, blatant WTO violations, is to say, well, someone has to defend the rules. And one of those rules is basically you've given China WTO access. You can't change your WTO access just because you don't like the result. You can't change your tariffs on China without going through all these procedures and filing cases, and it's really slow, and it kind of ends up producing strange results, like you tariff battery electric vehicles, but you don't put any tariffs on plug-in hybrids, and guess what? Plug-in hybrid exports go through the roof. So I think Europe, in order to be coherent, will eventually need to recognize that it needs to draw more on its demand to reduce its dependence on the US and give away less of its demand to China and put more of the burden back on China. For the Trump administration, the next move is the Fed. It's we don't like dollar strength, or we don't like maybe we like dollar strength, but we don't like high interest rates. So let's force the Fed to cut interest rates. Let's pick people to put on the Fed to cut interest rates. And frankly, that should bring the dollar down. That will test other countries' commitment to put money into the US, even when it is not in their financial interest to do so.
Okay, so I want to come back to that because that's very, very important. But so just to consolidate the picture that you made and then ping it off Mona and Karthik. So the picture roughly I have is something like the big question for China is, can they turn an export system into one with more domestic demand? The big question for Germany and the euro, although it's mixed, is can they turn the room that the euro can and does afford them into something, into a Keynesianism beyond, say, only military Keynesianism, right? So those are the two questions individually, and then there's the other question: how much are they going to? How much is Europe going to let China drink Europe's milkshake? That's the other big dynamic that we're seeing. I really want to come back to, because these are the my cheat sheet said the two next big impulses are either going to be direct weaponization of swap lines, not just rhetoric, but some kind of action, and Fed pressure. So I want to come back to those as the next to push you guys to prognosticate a little bit. But Mona and Karthik, do you want to jump in on this response dynamic, or should we get? I'm also happy just to get Leslie.
I wanted to respond to Europe doesn't need swap lines. I mean, Europe more than anybody else, and of course there are Asian dynamics here as well, where private investors purportedly from Asia, and Brad is really the best in terms of this forensic analysis. Europe's deeply invested in US treasuries. And so if we're seeing turbulence in the US treasury market with increasing short-term issuance, relaxation of rules where primary dealers get to hold more and more treasury securities, and then you can have gapping, et cetera, in the US treasury market. And so when that happens, when the next crisis is bound to happen, the credit crisis, Europe's going to be affected, and Europe will need the swap lines, as will the BOJ and other folks. So Trump can certainly weaponize the Fed swap lines, and he's threatened to do that, right? I see that the general direction, and it's really nice to hear Europe's long trajectory, but in the short term it massively capitulated 2 days ago, or 3 days ago. So I am not sure. Those of us who were students of globalization, that's what we learned in our undergrad and grad days. It's very troubling to have this world of focusing on internal demand, although I understand the logics, I understand national income accounting, but instead, under a different US administration, I think the key would be to really think about a new monetary accord, a new trade accord, a la Bretton Woods, but quite different. And one of the things to do is to think about the real cost, deindustrialization and other, of being, the exorbitant burden argument of being the world's hegemonic currency.
Thanks, Mona. Very quickly before Karthik, you come in here. I lost track of time. We're a little bit past the hour. If you all have questions, please put them in the Q&A box. We have a lot of momentum, so I'm going to keep on this thread for a moment, but I'm watching that box, so I will get to them shortly. So Karthik, I don't know if you want to come in on the global response, and then I want to get to the bit of the prognostic.
Yeah, just very quickly. I mean, I think I'm somewhat I'm more optimistic on the longer term, kind of on a more medium term trajectory. And also, I think one of the market indicators I look at it just where the Bund BTP spread is, spread between 10-year Italian and 10-year German debt, which was at I think 12-year lows. We're back to where we were in before the crisis. So I think even with so one of the things that I think is relatively positive is that market confidence in the structural integrity of the eurozone seems to be quite high. And my take on this is that yes, it's interesting that France and Spain have the same bond yields, but I think of it more as interesting than as worrying because it's at 3.3. It's at 3.3%. If it was at 7.5%, as it was in November 2011, I would be more concerned. So my read is that there's, at least from the market, there's a market perception that the eurozone has a larger set of. It does not have nearly enough safe assets, but the universe of safe-ish assets or safe enough has expanded, which implies some confidence in the argument that Europe has had the market confidence in Europe's Franklin moment. We must hang together or we hang separately kind of remains. To me, it seems to remain. The other point is that I was going to say, actually, we're probably a unique panel in that all three of us believe that the US should be engaging in more foreign exchange intervention, which I think is a minority belief pretty much outside. But all three of us, and Brad and I have kind of chatted about this on social media DMs. I think the U.S. should get into the exchange rate management business, and it should have done with dollar yen 2023, 24. So that's another story. On China itself, definitely agree that they should be doing a lot more, particularly using the central government balance sheet, which would serve two purposes. One is to change the structure of demand, and two, increase the global supply of CGBs, which I think is something that the world would like to have, because part of the story, if they're serious about, I think they seem to be serious about renminbi internationalization, but whatever form it takes, it's going to be slow, it's going to be halting, it's going to look very different from Europe, it's going to be bank centric. You can't do, there's not, I would love to see more Chinese panda bonds, things like that. But those are things that'll happen over the long term, or they may, at a very slow pace. But I think part of the story here is how will the US react to that? Because what we are seeing, part of the story here is an attachment to a unipolar global monetary order, not so much for financial reasons, but for reasons tied to security. The development of pathways that are opaque to the US but transparent to China, I think would be seen as a pretty severe problem. So, and one of the things I was kind of getting at in the piece was that even if you kind of take the view that, sure, you should have, China needs to rebalance, sure, China needs to allow renminbi appreciation, which I 100% agree with. What would the US response be to the counterparts of those in the international monetary system? which would be a greater role for the euro and the renminbi in the international monetary order and security implications of that. And that's something I think there are some pretty widespread reservations, certainly the administration, but even among others who might support the role of rebalancing patterns of demand, but not necessarily rebalancing the role of different currencies in the international monetary order, because that affects the ability to use it as a security tool.
So, okay, that's another good segue. I have a couple questions here about rates. So let's get into that scenario, which I want to do anyway. So Trump appoints Sylvester Stallone as the head of the Fed. In a couple months, rates drop precipitously. What happens? How does the world react? What happens to the dollar? Let's suppose like a significantly larger than expected rate drop. I'll ask you, Brad, first.
Yen rallies to 100 if the Ministry of Finance stays out. Probably the Ministry of Finance starts smoothing much more quickly. We saw Taiwan's central bank smooth or factually pretty much stop Taiwan dollar appreciation after a 10% move. So that would imply that somewhere between 120 and $130 yen, the Ministry of Finance would come in. When the Ministry of Finance comes in, that means they get dollars. Typically, those get recycled into treasuries. People tend to think that reserve-related financing is a function of dollar strength. That's absolutely wrong. It is a function of dollar weakness. So it becomes a test of when other countries' pain tolerance reaches the point where they come in and start buying dollars that the private market no longer wants to buy dollars, and slows or smooths the move. There is pressure on Europe to start cutting rates as the euro goes up. That particularly with the asymmetry and the tariffs, that will scare some people in Europe. They still do like a little bit of a net export contribution to growth. And then there's this lovely question. Remember the one country right now that unambiguously, other than Japan, where we're going to come down to Japan's level, but China has rates way lower than we do. China also effectively has a pretty tight linkage to the dollar right now. So a big fall in the dollar turns into a big fall in the yuan, absent a change in China's exchange rate management. And as the rate differential shrinks, the incentive for Chinese exporters to keep holding dollars, the incentive for wealthy Chinese investors who are now encouraged to set up factories in Southeast Asia to get around the tariffs, and in the process have a new opportunity to increase their holdings of offshore financial assets. Some of them are going to start looking at the yuan as a more attractive asset because of the change in the rate differential. So then the question becomes, does China go back to, or actually recently the state banks have been intervening a bit, but does it become a really big recycler through the government balance sheet? All these are kind of the dynamics you saw when the dollar down cycle happened in 2003. And what you saw then was that other countries didn't want their currencies to go up, particularly in a context where they're competing so heavily against China. And they ended up intervening and adding unprecedented levels to their reserves, and in the process, buying a lot of treasuries. I think, to me, the question is whether there is more tolerance now for a swing in policy, a swing in the exchange rate, less tolerance for piling into U.S. bonds, because the risk associated with piling into U.S. bonds are significant. The other thing the U.S. can do at some point is what we did with Russia, which is we can weaponize other countries' holdings of our debt. And, we've used that in a, I would argue, relatively restrained way. We used it against our adversaries, and we used it in response to a clear violation of an internationally recognized border. But this administration doesn't draw the same distinction between allies and adversaries. And so the more money you put in the US Treasury market, the more vulnerable you are to a future freeze. And so there are some offsetting considerations, the scale of US debt, the trajectory of the fiscal, the fact that the US is basically saying we want to inflate or erode the external value of our debt if we're going to cut rates with a monetary policy that's designed to lower our financing cost. Do other countries use their balance sheet to prevent the market reaction, which would be a much weaker dollar? I think money's coming into the US not because we're safe, but because we've offered return. And I think there's some risk of a reversal. So therefore, I don't think there's a market counterbalance.
Just to clarify that, because this is something that I like. The S&P has been whatever 12, 13% of the last 10 years. A lot of USD demand is coming from private market demand. So the dollar weakens. Money does not pile into tech stocks.
Hey, look, money seems to pile into tech stocks no matter what. And the future value of tech stocks, euro and yen and yuan earnings goes up the weaker the dollar goes. So you could, if you're going to have a negative real interest rate regime, one classic response to a negative real interest rate regime is you want fewer bonds and more equities. So that seems to me to be possible. It also seems to me to be possible that some sovereign wealth funds become a little bit worried about unhedged dollar exposure across the board and start to hedge some of their tech stock holdings. So I don't rule out some rotation into tech. No one who's in the past few years who's bet against the roller coaster or bet against the not roller coaster, the rocket ship up of the US tech industry has been happy about it. And that was true of people who thought they didn't want to be so overexposed to US equities in April. Look, the key thing I think to know about the world economy right now, two key things. One is that reserve growth finances the US deficit when the dollar is going down, not when the dollar is going up. It finances the US when US rates are low relative to the world, not when US rates are high relative to the world. And then the other key thing to know, well, the second important thing to know is that China seems to have made a policy decision not to add to its formal reserves, which is to me evidence that they are way past whatever they need for prudential reasons. If you need it for prudential reasons, you'd bear the cost. It would be a big decision by China to go back to adding to their formal reserves rather than channeling them through these more opaque channels. And then the third is that the US share, which is effectively the dollar share of a standard global equity market index, is higher than the dollar share of global reserves. So we talk all about reserve currency financing, and that's a bit misleading. If a median country took money out of its reserves and handed over to a sovereign wealth fund and invested in a global stock market index, they would typically increase their allocation to the dollar. Point being, I don't know what happens to equity markets. I do think it's a problem for total flows because the majority of the flow actually is through the fixed income side. And I think it's tied to US rates being higher than global rates and carry. And then it becomes a question of whether global reserve accumulation resumes or whether other countries accept this adjustment and say, hey, it just ain't worth it to take negative real rates on dollar holdings when the US fiscal trajectory is what it is, when the US external trajectory is what it is.
Thanks, Brad. Mona, did you want to comment on this? Or should I have other questions too?
So I like your 3 points, Brad, about the 3 important things to note about the world economy right now. And I think one has to recognize the role of the US as the giant wrecking ball, and what it means sort of for the future weaponization of the dollar. The United States, the Fed has not been a guarantor of the rule of law. It's been applied very differentially. I understand the whole Russia, the violation of international recognized borders for sure, but we should keep in mind that half of the world's financial sanctions are US imposed, right? That's half of sanctions on small poor countries. So one can have a nice conversation about financial markets and tech, but what does this mean for the rest of the world? This very disorganized, inchoate system, which is a welfare system for private finance, but there has been no significant move in terms of debt restructuring for the global south. And Brad has been good on this, pushing for greater debt restructuring for Sri Lanka and others, right? So what happens to the fact that we're cutting the US aid budget? And so that kind of vertiginous gap between those at the apex of the global financial system, which is dollar-based, and those at the bottom, we're creating, once again, an imperial hierarchy, which does not bode well for development in the global south.
Yes, I want to come back to the global south question actually in 1 second. To turn quickly, we have a question here about going back a little bit to sort of FDI and these trade deals substituting for U.S. industrial policy, especially around energy. The question asks, so the most of the purchase commitments in the EU deal are for energy, which seems hard for the U.S. to deliver. How seriously should we take this as a deal that'll happen, a deal that'll inflect U.S. policy and industry? That's the general question. I'd also sort of open that up to the broader question of FDI as a substitute for industrial policy in the U.S. If anyone has an answer to that.
My quick one is that the numbers seem extremely large. The EU put out an explainer that said it's going to be everything. It's going to be it's not just LNG. It's going to be supplies for nuclear power plants, all these other things. I mean, maybe I'm skeptical because I think part of Europe's story has been energy diversification, and because even if you stop gas imports from Russia completely, which is a stated goal that von der Leyen said, there's Norway, there's Algeria. So I think part of the European strategy has been to diversify. The other issue is that pipeline gas is cheaper than shipped gas. So I think between those two things, I find the $250 billion annually number a bit of a stretch. Let me put it that way.
Great. I actually want to close, unless anyone has a burning comment to make. We only have 5 minutes left. I want to close really on a question that Mona raised right at the top and mentioned again on the dollar strength in the global south. It seems like there are really 2 ways, broadly writ, that the current situation could benefit the global south. One is a much more multipolar currency system over the long term, as Karthik's written, sort of aligning business and financial cycles much better. We probably don't have time to dive too deep into that, but just one factor. And then the other, of course, is just dollar weakness. So I want to ask, sort of imagining again, Fed Chair Stallone, rates drop, dollar drops. How good is that for the global south, and how does their situation change? Mona, I can start with you, but I'd love to hear from you.
Yeah, I mean, of course it's good. And we've come out, 2022, 2024, 97 countries going to the IMF for funds, very, very onerous regime, public pushback. The IMF lets go of some of its surcharge policy, and everyone's being screwed, including Ukraine, although they did have a leeway where they had the biggest debt restructuring after Greece, right? So Ukraine has actually been able to kind of negotiate with US support with the IMF. So, exchange rate management, a cheap dollar is good for the global south, right? It's good for global growth. We know that However, that doesn't take care of the underlying kind of asymmetries in the system. And I mean, we do not have a precursor like the Sterling Standard too. It was a very imperial system, and we're seeing dynamics similar to that. And I think the focus on rebalancing the US trade deficit, while it's benign, Karthik, as you mentioned, or well-intentioned, possibly doesn't take care of the underlying asymmetries in the global financial architecture. How we solve that? I mean, I don't know, but it has to be multilateral. It has to be multipolar, and the global South has to have a voice in a way that it didn't in the first Bretton rounds in 1944. So, yeah, I mean, lots more to say there, but I'll stop.
I know. I'm sorry that I should have asked that. Brad, do you want to come into this as a card?
Well, I don't actually find the term the global South all that useful because there's not one global South, there are many. I would agree that for the subset of lower middle income countries that borrowed from a mix of private markets in China in the 2010s, a fall in US interest rates is actually very helpful. The most immediate effect, and this is kind of the irony, is that it reduces the cost of servicing the Chinese bonds or loans, which were all LIBOR linked. And so they come down very quickly with the fall in US rates. It will help refinance bonds as well. There's a broader subset of emerging economies, which didn't suffer financially as much as people expected from the Fed's rate hike cycle and from dollar strength, largely because they've moved into a position where their government's reserves, their foreign currency assets, exceed the government's, not necessarily the government plus the private sector's external debt. That's true for Brazil. That's true for Mexico. It's true for most of emerging Asia. Still true for Saudi Arabia. I was getting close. And so those countries in a narrow financial sense, arguably at the margin lose, but I don't think they care that much. They lose because the return on their foreign assets comes down with the dollar and their net dollar creditors. Why I don't think they care that much? They should see more flows into their local currency market, which is a broader positive. Then there's a subset of countries. I don't know if you consider Taiwan part of the global South or not, but there's a subset of countries which are just dollar creditors. They're not dollar debtors. And for them, rapid dollar depreciation is a financial disaster. Remember, the world as a whole is long dollar and long US assets to an unprecedented degree. And that is true throughout every part of the global economy. So there is a financial shock, and that financial shock will be acute in those countries whose financial systems have used dollar assets to promise a higher local currency return than they can deliver out of their local market. Final point, hey, if this is all associated with a dollar depreciation that actually brings the US trade deficit down, a lot of countries are going to be squeezed. The US trade deficit has been an important source of global demand. It has helped provide the glue that holds Asia's trading system together. It helps countries offset declining market share because of competition from China. So I actually think it puts a tremendous amount of pressure on countries to put pressure on China because they're going to see a fall in their outlet, which has been in the US, which makes it just harder to absorb all the output coming out of China. We are in a world which has an unprecedentedly large Chinese surplus, just looking at the customs data. There's essentially, outside of Greater China, most of the world is in customs balance. So the entire imbalance now with current oil prices in China. So if you want that adjustment, if China doesn't accommodate, I think you actually have a big problem.
Thank you, Brent. Karthik, do you want to close this out?
Yeah, I mean, just the one thing. Yeah, I would agree with Brad that I think what China does in response to a large weakening of the dollar is very important. If they ride the dollar down as they did between 2002 and 2008, that would be problematic. They may or may not they may or may not do that. The other point, because Brad said, Brad earlier had three things that people should know. I would like to add a fourth that I know Brad has approved of, because I watched to see every time he likes one of my tweets. And this is the idea that I think what Brad said about a weaker dollar is a huge problem for countries that have a lot of dollar-denominated financial assets funding local currency liabilities, and Taiwan is kind of exhibit A in that, but that's true in other countries as well. And kind of my broader pitch that I keep trying to make is that a safe asset is one that behaves in a predictable and commensurate way as your liabilities. I think I would love to get that into people's heads. It's not some big metaphysical thing around rule of law or Acemoglu or Fukuyama or anything like that. It is quite literally what it does in response to your liabilities. So that's kind of my parting fourth thing from here.
Thank you. This has been really incredibly interesting for me. And thank you to all three of you for just letting me ask you all the questions that I'm too shy to ask on Twitter. Thank you especially to Karthik for such a fantastic piece. And thank you to all of our guests for coming. This has been great. Thanks, everybody.
Thanks very much.
Thank you.
Thanks, Brad. Thanks, Mona.